Governments issue debt instruments in the form of bonds, bills, and notes to finance their current spending and with an obligation to repay this amount plus interest at maturity. The rate at which governments can borrow is often called the risk-free rate and is defined as the yield on those government securities. These rates play an important role in evaluating the health of an economy. In Australia, the risk-free rate is considered to be the 10-year government bond yield, which at the time of writing is equal to 2.66%. In financial markets, risk is measured as the deviation of actual returns from expected returns. Thus, a risk-free investment must meet two conditions. 1. There is no possibility of non-payment. 2. Expected returns exactly equal actual returns. In reality, there is no completely risk-free investment that an investor can make, meaning that a proxy rate must be used. This proxy rate must be the rate of return on an investment which has as little risk as possible. The most appropriate proxy for a risk-free rate of return across the world is the yield on a government-issued bond. However, this means that the risk-free rate varies across countries according to idiosyncratic risk factors such as inflation and currency expectations, and as shown on the map. All other things equal, countries which are riskier also tend to have higher risk-free rates, as these are the minimum returns that an investor would require to invest in that country. Bonds are also subject to the forces of supply and demand in the open market, where inflation and currency expectations play an important role in setting their yields. Credit ratings agencies help to determine the risk-free rate. In the case of countries, these agencies assign each a rating which indicates its ability to service the principal and interest repayments on the bonds which they issue. Generally, a higher rated country has a lower risk-free rate. Australia maintains a AAA rating according to Standard & Poor's, whilst a country such as Turkey maintains a BB rating. These agencies exist to overcome informational inefficiencies in financial markets, giving investors an independent evaluation of the creditworthiness of debt securities. Thus, these agencies play a noteworthy role in determining the risk-free rate on government-backed securities across the world. The market for ratings agencies is dominated by three agencies with 95% of the industry: Moody's, Standard & Poor's, and Fitch, collectively known as the Big Three. Each agency uses their own rating methodology to assign a rating to a particular security. These ratings are then used by financial institutions to determine the risk premium charged. Most countries sell their debt securities on the open market, and most investors will rely on ratings agencies and the ratings provided in their investment decision. Depending on the investor's risk appetite, this may range from AAA bonds to lower-rated bonds, often called junk. By definition, countries that issue bonds and other debt securities enter into debt. If they can't use government revenues to service this debt, they will need to continue to borrow to meet their current obligations. Countries will often borrow from large financial institutions, investors, and other countries or institutions such as the International Monetary Fund. Although it tends not to happen, it is not uncommon for countries in distress to default on their repayment obligations. For instance, in the late 1990s, Russia experienced an economic decline caused by political instability, a downturn in commodity prices, and the Asian financial crisis, which weakened their foreign exchange reserves. The following recession was met with a $22.6 billion IMF and World Bank recovery package to stabilise the economy. But things continued to get worse, with huge capital outflows and large amounts of uncertainty caused by a weak market system and continued macroeconomic instability. Russia was forced to devalue their currency, increasing their repayment obligations and causing them to default on their debt. The country only made it out of this downturn due to large inflows of humanitarian aid and an increasing oil price. Similarly, in 2001, 3 years into a 4-year depression, Argentina defaulted on $96 billion worth of foreign debt. This was primarily caused by extensive foreign borrowing, which left it unable to deal with external shocks such as the Asian financial crisis. By July 2001, the country lost total access to international financial markets. In November 2001, the country was forced to devalue the peso and freeze deposits anticipating a bank run. In December of that year, President Rodriguez Sá announced the default. Argentina only began restructuring this debt in 2005 when the country resumed payments for the sovereign bonds which were defaulted in 2001. The debt was again restructured in 2010 when the repayment rate was increased. However, Argentina defaulted again in 2014 and was given additional funds in 2018 by the IMF. To put this into the context of a risk-free rate, in 2001, when Argentina defaulted on its debt, the yield on their 10-year government bonds was over 20%, and their bonds rated as junk by all three ratings agencies. Russia similarly had high government bond yields at just over 10%, with junk ratings given by all agencies when they defaulted in 2001. There is much debate regarding whether Greece technically defaulted on its interest repayments to the IMF in 2015. Whilst they certainly missed their repayment obligations, the IMF referred to this as being in arrears. However, many market commentators and analysts dismiss this as semantics and as an attempt to sugarcoat the crisis unfolding in Greece. Nonetheless, as the most salient sovereign debt crisis in the last 10 years, the circumstances will be examined. Although Greece never fulfilled the criteria to be a member of the EMU, they were granted admission in 2001. Their membership of the EMU meant that investors placed more trust in Greece's ability to service their debt obligations, decreasing the yield on government-issued debt securities and allowing them to borrow at a cheaper rate. This means that as they continued to borrow to finance their economic growth, their deficits continued to rise. As they chose to either postpone maturities or issue new bonds to cover repayments on old bonds instead of increasing domestic taxes to meet current obligations, their level of debt began to skyrocket. In 2009, their debt to GDP ratio was at 125%. When details of Greece's economic misreporting emerged in 2009, investors began to lose confidence in the economy and capital outflow ensued. This was further compounded by a ratings reduction in Greek government bonds by S&P and Moody's, causing yields on government-issued bonds to rise. From 2010 onwards, yields on Greek government bonds continued to rise drastically, hitting 35% in 2012. As a member of the EMU, they were forced to adopt austerity measures so that they could receive over $140 billion worth of loans from the EMU and IMF. Unfortunately for Greece, their crisis was a mix of both endogenous and exogenous factors, wherein years of economic mismanagement was exposed by a global downturn originating from the US housing market. Further, as a member of the EMU, they were prevented from exercising full control over their monetary policy, which was out of sync with their economic cycle. It is not uncommon for countries to default on their debt obligations. Although there is a multitude of factors that underpin a sovereign debt crisis, the underlying problem appears to be economic mismanagement. In all three examples discussed, it becomes clear that sound economic management and a rigorous framework for monetary and currency controls are the best prevention to a sovereign debt crisis. Governments issued